Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. We've had a few crazy developments over the past few trading sessions, so I want to quickly go over what's been going on. Now, we think that the S&P 500 is currently heading into a major long-term top that's probably going to be followed by a bear market. We have both forward and trailing PE ratios near dot-com bubble levels here in 2021. We're clearly getting into overvaluation here. We're seeing AAII allocation to stocks at extremely high levels, similar to what we saw here in 1997, 1998, and throughout the entire dot-com bubble. So there's definitely a lot of sign of speculation in the markets. We've been covering that for weeks, for months now. But this type of environment can go on for quite some time. And it's also a sign of a very strong market in an environment where cash and bonds are extremely unattractive investment. So it's important for us not to flip to bearish too quickly. And here, as we saw this panic move down, I posted a video as we were bottoming here a couple of days ago. And both on Twitter and on YouTube, we had so many people calling for this to be the top, calling for much lower lows, and we just do not think that's the case yet. We're going to see a lot more crazy upside, a lot more crazy price action heading into the end of the year, and we do intend on taking advantage of that. If you're interested in following this crazy market with us, make sure to smash that subscribe button. And now, without further ado, let's get right into it. So a few days ago, on the 21st of September, we posted this thread on our Twitter account covering exactly why the risk-reward ratio on the markets was extremely favorable as we were bottoming here. We talked about the CNN Fear and Greed Index that was below 20. We talked about the market breadth that was oversold. We had the put-call ratio spiking, the VIX at resistance, the S&P 500 at support. So those were all signs of the market's bottoming here near that 100-day moving average. Hopefully some of you guys were able to take advantage of that. Now, we still believe that the risk reward right now is extremely favorable. I'm going to show you here the fear and greed model using a 50-day moving average on this indicator. Again, we talked about this in the last video. You can see over the past 50 days, we've seen this indicator come down to extreme fear. The moving average of the last 50 readings are extremely low. It's showing a lot of fear in the markets right now, and every time that corresponds to big market bottoms. So not only is this probably a temporary bottom, but we believe that this is a very significant bottom looking out over the next few weeks, possibly over the next few months. Now, we're not trying to predict the short-term price action, right? Still have somewhat of a bearish structure here with this bearish price channel. We could see a little bit more volatility in the next few days, come back and retest that 100-day, possibly retest that low before really bottoming. That's possible, but the point is we don't think we've seen the top just yet. And also from a technical standpoint, again, not trying to predict the short-term price action, but we do have a bear trap here, right? This nice price channel, very well defined, lots of resistance, lots of support, and then you've got this bear trap. Typically, that's a pretty bullish development here. By the way, if you're so far enjoying this video, make sure to drop a like. It takes a couple of seconds. It helps our videos out so much. This is a quick update that I wanted to make just to show you guys exactly what's happening on the charts. If you appreciate those quick updates, make sure to let us know by clicking on that like button. Now let's take a look at what's happening on the bond market, because I always want to look at what's happening with bonds before I actually make up my mind on what's happening with the stock market. Let's first take a look at the high yield bond ETF JNK. It held up incredibly well throughout the last correction here, better than the S&P 500. We're still near the highs. We're not seeing any type of breakdown, not showing a lot of fear in the markets and showing that risk taking is still elevated. That's a good sign. And if we jump to TLT, this is the Treasury bond ETF, right? So this is where investors seek safety. And if you remember a while back, I believe it was this video a couple weeks ago, we covered this subject in detail, why FOMO will drive stocks into a massive long-term top. And we covered a couple of indicators that were showing that investors were excessively cautious and were positioned for rates to fall. So in other words, they were positioned into the bond market expecting an ETF like TLT to rise over the next few weeks because they're seeking safety. They think that we're going into a recession. They think that the Delta variant is going to have a big impact on the economy, that inflation peaked, and that we're now heading into deflation. Those are all arguments to be in bonds. But if you watch that video, you'll know that, first of all, it's a bad idea to be invested in an asset where a lot of people are expecting upside, like the bond market at this moment right here. And also the fact that we expect inflation to remain elevated throughout the rest of the year. And so if you're going to have high rates of inflation throughout the end of the year, why would investors hold their bonds? There's no reason to be holding bonds in a 5% inflation environment. And this is why you're currently seeing this false breakout on the bond market and bonds selling off very quickly here. The reason I'm talking about all this is because treasury bonds have a very strong inverse correlation to the stock market. When you have bonds fall, you typically see stocks rise, because investors come out of the bond market and come into the stock market. When you see bonds rise, that typically means that investors are taking less risk, coming out of the stock market and coming into bonds. And so when you know that investors are positioned for bonds to rise, then that gives a great risk reward to enter into the stock market, because all those investors, if bonds continue to fall here, they're going to capitulate out of the bond market and come into the stock market, right? And that's going to create FOMO. That's going to create big rallies on the stock market, lots of upwards pressure on equities. I'm going to show you exactly what I mean. Let's put up a weekly chart here, and you'll see that inverse correlation perfectly. As bonds rise, stocks fall. As bonds fall, stocks rise. We've talked about this many, many times. So if we're expecting a fall in bonds here, however shocking that may be, that's going to bring stocks higher. Now, all of these concepts are a little bit more difficult to understand than the classic TA that we often do on this channel, but it's incredibly important to understand these concepts for you to navigate this market successfully and with the right mindset. A lot of people are calling for downside on the stock market without really knowing why they're calling for downside. And that's why you're seeing just such a tremendous opportunity right now with the fear and greed at extreme greed, despite so much potential firing power to send stocks higher. And so that's exactly what we try to do at Game of Trades. Through all of these videos, through all of these articles, we try and give you guys the complete picture on the equity markets, taking a look at what's happening with bonds, taking a look at our expectations for inflation, economic growth, lending or tightening standards, and of course what's happening with the sentiment. And we give you guys frequent overviews of the risk reward on equities, right? This was that article on the 21st of September. If you were a Game of Trades member, you saw this article where we took a look at what was happening on that dip in detail. At the very, very bottom of that move, we talked about the markets being oversold and being at an attractive risk reward. Now, of course, on top of actually looking at the stock market, we look at individual sectors and whether those sectors might be even more attractive than the actual stock market and the reasons why. Again, the primary objective of our website is not to give you guys forecasts, although, obviously that's a very useful thing to do, but actually tell you guys why we have our certain convictions on certain stocks and certain sectors and how all the pieces fit together to build a real bullish case on an asset and on what time frame. If you're interested in checking out our website, make sure to click the link in the description below. Get a free trial. We're trying to get as many people to sign up before we have the update because we're going to change the membership plans. So again, it's free. Just go and check it out. It's tremendous value for the price that we're asking. So now that we've had this big breakdown on TLT, we can start to aim for some lower targets here. I think at the very least, we're going to come back down to test this $140 level and possibly come down all the way to the bottom here of this channel at around 120. If we take a look at the 10-year yield, again, this is a chart that's perfectly inversely correlated the actual bond prices. Let me just put up a chart of TLT here. You'll see that relationship, right? It's a perfect mirror image, yields versus bond prices. As bond prices go up, yields go down. Now, of course, this is TLT, so longer term bonds. This is the 10-year yield, but the technical picture is very, very similar on those different maturity rates. But the point I'm trying to make here is that if we look at the longer term chart on the 10-year yield, you'll see that this is the cycle, the environment that we've been in since 1994. We've been in this beautiful channel here, bounced off this level of support here during COVID as we saw stimulus come in. This was the top in yields in 2018, right after the taper announcement. And you can see here we had this first leg up, counter correction, all right, and now we're breaking out, and the next big target is at around here, right? And so this is exactly where we'll be buying bonds and selling our stocks, not here, but here. When we get to around a 2% yield, we'll have a lot of resistance here. That will be the moment to be buying bonds. You'll have a good yield on your bonds. And so what you'll see happen is TLT do this type of move, right? Mirror image, bottom around here. And that will be a great risk reward for treasury bonds for a nice trade up back to the all-time highs as we see bonds come down into the zero range. That's what we expect to happen. So hopefully this was a good quick update showing you guys everything that's been happening on the charts over the past couple of days, the important developments, whether anything's changed in our end of year rally thesis, expecting a massive longer term top towards the end of the year as we see this FOMO rally really push equities into historical valuation. You're going to see price around 30x. Earnings yields are going to be extremely low at those highs. Stock market to GDP will be, of course, off the charts, but the top is not in yet. You still have a lot of firing power from the bond market right now, and you don't want to be missing out on this rally here. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button as hard as you can. And in the meantime, I wish you good luck on your trading.